So we're not that far from 4%. It's almost like the market is in almost there mode and feeling as if it can get some relief from watching the Fed try to catch up to inflation.
Well, and I think the Treasury market is in that almost there mode, because we can see that with two-year yields. The two-year yield is reflecting a lot of this path forward of where the Fed is expected to go. The question is, has the equity market or even the credit market fully reflected the degree of tightening that the Fed is doing? And that probably speaks to the fact that Fed tightening affects the economy and it affects certain parts of the market with a lag.
For sure.
So that's one of the reasons why the Fed's saying is we want to tighten and then see how things get digested.
You know, we got this very strong rally off the June lows. You've talked about that. Some of the breadth and momentum indicators were quite powerful and usually give the market the benefit of the doubt if you look out several months. This rally, you've seen a little bit of that, but I'm not sure how it stacks up. But we've kind of solidified this idea of a trading range we've been in most of the summer.
Yeah, and we have been getting more and more narrow in this trading range. It's now in that 4,200 to 3,900. And any time we get into this narrow period, you can tell that there's a lot of push and pull between the bulls and the bears. And so on the bullish side, you can see that we've had better momentum. You see that positioning is still very light. That could support that the pain trade is higher in the near term. But then on the bearish side, we look at valuations still being rather elevated given Fed tightening. We look at where earnings estimates are, given that they're probably still too high for 2023. And that's likely why we're seeing this battleground and this convergence. And we will have to watch to see which way it breaks.
If you're an investor trying to figure out if there are moves to make, reallocations to think about in that environment, if you say to yourself, look, the June lows look relatively solid unless we get some big macro shock. Valuation doesn't look attractive, so maybe the market's not going to run away from me on the upside. What does it leave you to do except to maybe just adjust your return expectations?
Well, I think that is actually the biggest first step, which is that after such strong markets over the last 10 years, given where we stand in valuations, given where we still are in equity allocations, one of the best forward predictors for long-term returns is investor allocations to equities. They're down off their highs, but they're still well above where they were after bear markets like 08-09 or 2000-2001, which sets you up for very powerful bull long rallies because positioning was so light and sentiment was terrible and valuations were weak. Now that's not really the case. So lowering your expectations is really helpful. And then the next step is focusing on quality, because we think those are the areas where you can compound growth over the long run. Buy names that you don't have to sell in the next down cycle, essentially.
And you do still think that oil and energy is an opportunity here? Why would that be?
Well, we think that we could be getting into an interesting supply-demand balance as we move into October, because October marks the end of the Strategic Petroleum Reserve releases. We've released 180 million barrels of petroleum, and we're now down at 1984 levels in inventories. We also have the China Party Congress on October 16th. China demand has been incredibly weak because of COVID lockdowns. If those are eased, we could see demand come back, put upward pressure on oil prices. And lastly is OPEC. They're meeting again. We could see them cut production again if they're unhappy with the level of where oil prices are. That would tell us to see upward bias in oil prices over the next month or so.
Would quality, let's say outside of some energy names which would qualify, encompass things like the very large tech stocks that, kind of drove the market to such a degree into the 2021 highs and now have led to the downside?
We think they can, but you have to be very disciplined about valuations. You can't just pay any price. And you also have to watch in quality and updating your thesis about each name, meaning that we've seen a lot of big tech names have to do big investment cycles, for example, where we've seen cash flows come in much weaker than expected over the past year, or that you're seeing growth slow because of the pull forward in demand. And so having that discipline about where you see cash flow, where you're seeing investment spend, as well as on valuation, really is needed within the tech sector, because a lot of the areas of tech are still rather expensive.